So boring zone 2012, 27%. Boring zone 2016, 38%. Boring zone 2020, 20%. Boring zone 2024, 27%. Right. So it's smack in exactly what you'd expect. And what comes next is the banana zone. And I don't want you guys to miss it because you're getting caught up in short-term time horizons of traders on Twitter. And that this macro spasm is actually the opportunity to really think about this, how you want to get involved, where you can find money to add. So this is the opportunity that you've been asking for. This is the last chance to be able to do all of this.
The onset of the banana zone is one of the most eagerly anticipated events for cryptocurrency investors in 2024. The term was coined by Real Vision founder and CEO Raoul Pal, who describes the banana zone as the peak phase of every cryptocurrency bull market when prices go bananas. According to Pal, the banana zone begins after the full transition from macroeconomics spring to summer and extends well into the fall, fueled by central banks injecting more liquidity into their economies. However, the transition has been less smooth than expected. Instead of the massive price surges typical of the banana zone, the cryptocurrency market recently faced a downturn, with over $6 trillion wiped off global stock markets. Major cryptocurrencies like Ethereum and Dogecoin lost as much as 27% on Monday, and have yet to fully recover. Pal refers to this current phase as the boring zone, a period before the banana zone when prices either stagnate or experience sudden, unexpected dips. He believes the boring zone is nearing its end, tweeting, "The banana zone soon cometh." The boring zone is a gift, and your last chance to load up before things go bananas and you lose your mind in an orgy of FOMO and greed. But please, don't mess this up. Pal remains unfazed by recent price fluctuations, noting that previous bull markets saw even steeper drops, which didn't prevent the eventual arrival of the banana zone. In his latest video update, the Real Vision founder discusses the banana zone and his everything code thesis, which details the convergence of the business cycle and the crypto bull market, with central bank liquidity expected to drive rapid price increases and economic growth over the next 12 to 18 months. Despite current market conditions, Pal is convinced that central banks are on the verge of releasing a flood of liquidity, which he believes will usher in the banana zone, potentially growing the cryptocurrency market from $2 trillion to an astounding $12 to $25 trillion by 2025.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So liquidity is the prerequisite for markets to rise. And so that is all coming into the play. And now we've been given the reason. You know, people say, well, we need something to break. Well, guess what? We had it today. So we've got that. So global liquidity, when I look at it, global liquidity is about to break out too. I know you might think of this as a sin, doing technical analysis on the global liquidity index, but hey, it just shows the sideways contraction in global liquidity and the likelihood that it plays out, driven by the US, driven by Japan, driven by China, and also eventually driven by the Europeans and everybody else, because they all need to refi their debts. That's the big game, the everything code game. And global liquidity drives crypto. So if global liquidity is going to break higher, crypto will too. So if you've got to think of these moves that we're seeing currently as wiggles on the path of the main trend. And what you tend to do, it tends to overextend in bull markets, and we should see that in due course. So as global liquidity rises, cryptocurrencies will rise, as will other markets like NASDAQ. The other thing is global M2. Global M2, many of you have pointed out, is starting to rise. It's starting to break out. As that breaks out, that's led by financial conditions. So global M2 is rising, another liquidity measure. Global liquidity is going to rise. Financial conditions are going to rise. Okay, this is what we're looking to see. This is the macro summer signature, the macro full signature, the times when debasement comes, the times when assets do really well. You can see Bitcoin, how sensitive it is to global M2. As global M2 starts picking up, Bitcoin year on year should start picking up too. So again, I don't see anything concerning in the macro picture. The macro picture is incredibly supportive of higher asset prices. So that's why I think we're dealing with a spasm and not a regime change in macro, where we're going into a recession or something like that. In fact, it's the fears at the bottom of the cycle that's causing this. As the cycle starts to rise, and things like the dollar needs to start weakening. It's not fears the other way around that the cycle's about to fall apart. You can see the financial conditions index also affects S&P 500. Equities are driven by financial conditions. So there's a 6-month lead here. So as financial conditions start easing, that's the number going up, the S&P 500 should follow suit. So again, we expect to see stronger equity markets ahead. Emerging markets, they're driven by financial conditions, 6-month lead. Emerging markets really a function of the dollar, which is part of the financial conditions index. Financial conditions, our measurement is the dollar plus rates plus commodity prices. And we're seeing those ease, and that should put emerging markets higher over time for those of you who trade them. Tech stocks, 6-month lead, same thing. Tech stocks have been correcting and had obviously overshot financial conditions somewhat. And again, we should be looking for a base over this period of time. This volatility, for those of you who aren't kind of max allocated to this stuff, this is the opportunity you're really going to want, because NASDAQ again should take off from here around these kind of levels. Now, again, I'm not talking about today or tomorrow. I'm talking about over the next 3 or 4 weeks. We should start to see liquidity coming, financial conditions coming, and equity starting to scream higher again. The big driver here is the PBOC. Right now, the PBOC have this cyclical pattern of every second half where they start injecting liquidity into the system. Additionally, we know they have a bigger cycle, much more like 2020, where they've got to deal with the debt deflation issues at home. So they're going to have to do quite a lot of easing, and they're going to do quantitative easing, and they're going to do all the liquidity measures necessary.
According to reports, markets are anticipating that the Federal Reserve will step in to prevent a recession by announcing significant rate cuts during the September FOMC meeting. Traders and investors argue that the Fed has made a serious miscalculation by keeping rates too high for too long, similar to how it allowed inflation to soar to multi-decade highs before beginning rate hikes in 2022. A leading economist noted that while there may not be a recession in the US today, that could quickly change by the end of the year if the Fed doesn't start cutting rates by September. Raoul Pal shares this view, pointing out that the market is frustrated with the Fed's quantitative tightening policies and Chairman Jerome Powell's hawkish stance, despite the strong market reaction. However, Pal predicts that Powell's hawkish approach will quickly reverse at the first sign of trouble, especially as the November elections approach. The Biden administration, already facing significant unpopularity due to its economic policies, cannot afford to let that reputation persist if the Democrats hope to succeed at the polls in November. This is why Pal is confident that quantitative easing is imminent and that it will be swiftly followed by the banana zone. Here are more clips from the video.
So let's talk about the banana zone, because everybody cares about the banana zone. All of our hopes and dreams are in it. And I don't want the stupid, well, you promised bananas. I've never promised bananas immediately. I've told you this is how it plays out. This is a period of time. I've also talked about the boring zone. So you've seen this chart before, but now we've just added the percentage corrections in the boring zone to make it even more clear to you guys how this works. So boring zone 2012, 27%. Boring zone 2016, 38%. Boring zone 2020, 20%. Boring zone 2024, 27%. Right, so it's smack in exactly what you'd expect. And what comes next is the banana zone. And I don't want you guys to miss it, because you're getting caught up in short-term time horizons of traders on Twitter. That's their time horizon. Nothing wrong with being a trader. I just don't think you'll make as much money. So I think you're better off to think of the long-term gain is, how do I use these kind of opportunities to put as much money in as possible so I can capture the big upside when it comes. And I've shown you why that's not just a hunch based on these charts. It's actually based on the everything cycle. And that this macro spasm is actually the opportunity to really think about this, how you want to get involved, where you can find money to add, how you can get your portfolio set. It applies to tech stocks. It applies to equities overall. It applies to emerging markets. All of these things are setting up perfectly. So this is the opportunity that you've been asking for. This is the last chance to be able to do all of this. So I look at these with glee and say, thank you. All I need to do is find some money to put in, because I'm max allocated, but I do have an income. So, I try and scrape my bank account for any excess that I've got that I won't need over the next few months and stick them into markets. I mean, I don't sell anything in crypto. I've not sold anything, meaning my overall portfolio at all since 2020. And I just continue to compound and add, and that's worked for me really, really well. for those of you who keep asking, no, my allocation hasn't changed. It remains that my core portfolio is in Solana. I have some memes, which are WIF, Bonk, some Doge. And if those go up and down 80%, it doesn't matter to me. It's fun. I actually think they'll do well. You may have a different token. They're not my recommendations. I'm not trying to shill you into buying anything like that. If you just want to stick with Bitcoin, it's fine. Ethereum has been a hairy ride. Now, part of what's been going on is jump trading have been dealing with legal suits with the SEC, CFTC, and others, and are closing up shop in market making in crypto. And they've been fire selling everything. And that's created a huge overhang. A lot of this boring zone has actually been the overhang of selling by Grayscale as they unwind the trusts, Germany selling Bitcoin, Mt. Gox selling Bitcoin, the FTX estate selling Solana and other tokens, and then jump trading. So that's what's been causing this really. This last spike was this macro spasm on this small macro shock. And again, let's see, because, let's see what happens with the Iran-Israel situation, because that could create another period of fear. But generally speaking, you get fearful of the rhetoric and buy the bullets. That generally has worked in markets over the years, although, trading war is never not something you want to aspire to, but that's how it generally works. So the boring zone driven by excess supply. Also, we've got a lot of token unlocks from newer projects. So all of that supply plus all the amount of memes has taken a while to digest. Liquidity will digest it. Think of it as eating up all of the supply as the holders from the last cycle where things went wrong, like the FTX estate, etc., start divesting those assets, putting them into stronger hands, allowing the markets to rise over time.
The banana zone is approaching, and your main task is to hold on to your tokens. Or as Raoul Pal puts it, don't mess this up. According to the former Goldman Sachs executive, every bull market has its ups and downs designed to shake you out of your position. Your only job is to hold on tight and patiently ride the wave to enjoy the rewards. In a tweet, the Real Vision CEO stated, "The job of every bull market is to throw you off. Your job is to not part with your tokens. That is your single job. If you can just not mess this up, keep hold of your tokens, and eventually, the banana zone comes, and we can realize some of our hopes and dreams." While there's always a risk that the banana zone may not materialize, Pal doesn't see that happening based on his macro analysis. He acknowledges that nothing is 100% certain, but the odds are in favor, and the Everything Code supports this outlook. Pal also mentioned that it's hard to pinpoint the exact market bottom, whether it's today, next week, or later, but advise finding ways to invest more into these markets gradually, such as through dollar cost averaging. Are you still a believer in the banana zone, or do you think it's all over? Please share your thoughts on Raoul Pal's video in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.